Thank you, everyone, for attending today's presentation. I am Chris Brown, the Director of AMLATF Conduct and Corporate Authorizations, the Bermuda Monetary Authority. I would like to welcome you to this outreach session presented by the AMLATF Supervision Team, covering the key outcomes from the recently published 2020 Bermuda National AMLATF and Terrorist Financing Risk Assessment, and our updated General AML-ATF guidance notes. It is my pleasure to introduce today's presenters. Selden Woolridge is a senior analyst in the AML-ATF Supervision Department. He works in the Risk Analytics and Policy section, focusing on matters relating to risk analytics, data calls, updates to the guidance notes, and updates to the National Risk Assessment. He has been with the authority since January 2019. Vashon Blanchette is a principal in the AML-ATF Supervision Department and leads the team that is charged with supervising long-term insurers, trust service providers, and corporate service providers. He previously worked in the financial stability area and has been with the authority since November 2008. Gentlemen, over to you.
Good day. Bermuda's latest iteration of its money laundering, terrorist financing, national risk assessment, the third such iteration, was released in April 2023. Following on from this, in June 2023, the Bermuda Monetary Authority issued updated guidance notes for its anti-money laundering, anti-terrorist financing, regulated financial institutions on anti-money laundering and anti-terrorist financing 2023 guidance notes, following a period of industry consultation. This session will focus on the key outcomes of Bermuda's latest national risk assessment and the important revisions to the AML-ATF guidance notes based on feedback gathered during the consultation phase and trends identified during the on-site examinations. This presentation will also discuss the major changes to the 2020 MLTF National Risk Assessments and what they mean for the AML-ATF regulated financial institutions. Finally, we will conclude with the importance of understanding Bermuda's AML-ATF obligations and MLTF risk at a national, sectoral, and institutional level. In this portion of the presentation, we are going to focus on the results of our latest National Risk Assessment, or NRA, and highlight key changes and messages arising from this extensive analysis. In March 2021, the authority conducted industry outreach sessions on the NRA. During that time, we shared with you the draft results of the 2020 Money Laundering National Risk Assessment. In particular, we presented the draft high-level sectoral results. Now, we will provide an overview of the objective of the National Risk Assessment process, share the finalized high-level sectoral results, and highlight the importance for RFIs to include the results of the NRA in their risk framework. We will cover both the ML and TF aspects of the NRA. Many of you have already attended the outreach sessions on the National Risk Assessment, or NRA. It is important to highlight some key takeaways that were emphasized in the latest NRA here because they have a direct impact on how we view MLTF risk nationally. Much of what we know about the domestic MLTF risk has not changed. We know about the trends in cash exchanges and predicate crime in relation to drug trafficking, corruption, and bribery, impacting the MLTF risk domestically. Internationally, however, due to the nature of Bermuda's international business, the NRA took a closer look at foreign predicate offenses and cross-border threats. For the cross-border threat analysis, 12 countries were identified and assessed, as they featured most prominently or frequently in trade in goods and services with Bermuda, foreign investment, cross-border aspects of criminal cases, tax information exchange requests, or other international cooperation in criminal matters. Analysis determined that predicate offenses posing the highest threat of money laundering to Bermuda primarily originate from overseas and are fraud, corruption, bribery, insider trading, market manipulation, and international tax crimes. More recently, we have seen that the trends in predicate offenses of fraud and cybercrime have continued to be a major MLTF risk for Bermuda. Moving to a summary of the money laundering threats. Bermuda's national ML threat rating in 2020 has been raised from the 2017 rating of medium high. The change in rating reflects a progressively better understanding of the ML threats to Bermuda and deeper analysis of the more comprehensive data and information rather than any major changes in the threat profile. It also reflects even greater expertise and experience Bermuda has gained for such assessments. As seen on the screen, the money laundering threats and vulnerability ratings by sector. The NRA also took a deeper look at product service risk for all sectors. For the 2020 NRA, we assessed the products across sectors in a more granular detail. This product analysis supported the vulnerability assessments. The table on the screen shows the 2020 results for the 16 sectors assessed, including the underlying threat and inherent vulnerability ratings which led to those results. Of the 16 sectors assessed, only the trust business sector was rated high for money laundering risk, while 5 sectors were rated as medium high, namely banks and credit union, corporate service providers, securities, and regulated insurance. This result is different from the 2017 results when both the banking and CSP sectors were rated as high, and trust business was rated as medium high. The rating for the trust sector has been negatively affected by the findings related to the threats faced by the private trust companies segment of the sector. The threat level was raised as a result of a specific case and associated intelligence during the review period, which has served to highlight the capacity which PTCs have for the misuse for tax evasion and ML purposes. Therefore, the highest priority sectors for supervisory attention are trust service providers, banking, and credit union, securities, regulated insurance, corporate service providers. This prioritization is based on the level of vulnerability to money laundering and the importance of the sectors to the economy. Among the other sectors, MSBs have been identified as the next priority sectors for supervisory oversight based on their vulnerability assessments being rated as medium. Turning to the terrorist financing national risk assessment. This aspect often gets overlooked, but is equally as important. The terrorist financing threat to Bermuda was again assessed to be low. There was no domestic or foreign-sourced intelligence to suggest that terrorist financing has occurred in Bermuda in any sector. The TF threat was also rated as low across the relevant sectors, other than banking, money service business, and not-profit organization sectors, which were rated as medium low. There was no evidence indicating that Bermuda is a site for domestic or foreign terrorist activity or transit point to move funds from one country to another. Despite these findings, Bermuda's ATF regime remains robust, and the Bermuda authorities are vigilant, recognizing that no jurisdiction is completely immune to the TF threats and terrorist activities. In this respect, RFIs cannot forget or ignore the threat of TF risk. TF payments are often low amounts that come from legitimate sources and are consequently hard to identify, However, we cannot be complacent as a jurisdiction and must ensure our RFI programs appropriately address low-level risk assessments. You may ask, what do the NRA results mean for me and my organization? As a regulated financial institution, it is important to consider these national money laundering and terrorist financing threats, along with the sectoral and product service vulnerabilities highlighted in the NRA. Individuals should be reminded to read the NRA for general knowledge, consider the threats and the risk, focus on the areas that impact their sector, and discuss the impact on their company and their AML-ATF framework, including their systems, procedures, and controls. I will now transition to my colleague, Vashon Blanchette, who will be speaking about the changes to the AML-ATF General Guidance Notes.
Thank you, Selden. As mentioned, we will now turn our attention to the major changes to the General AML-ATF Guidance Notes. We regard it as very important that you are aware of your regulatory obligations and understand how to appropriately apply these guidance notes in practice. The way we are approaching this is through a series of questions and answers based on questions received from external stakeholders. Our objective is to raise awareness about key enhancements to the guidance notes to ensure that you, our regulated financial institutions, understand your regulatory obligations and are therefore compliant in your application of the general guidance notes.
We'll begin with some questions about independent audits. Are internal audit reviews the same or different from the independent audit of the compliance function required under the regulations?
Thank you. With respect to this question, it is important to consider a few things. As you are aware, an internal audit is normally conducted in order to evaluate a company's controls, corporate governance, and accounting processes. Audits also seek to ensure compliance with relevant laws and regulations. In accordance with Regulation 17A of the Proceeds of Crime AML-ATF Regulations of 2008, an RFI must ensure that its anti-money laundering and anti-terrorist financing policies, procedures, and controls are evaluated by a qualified and independent person. In consideration of the question posed, in-house internal audit personnel can perform an independent AML-ATF audit. However, this personnel must not be involved in establishing or performing any of the RFI's ongoing AML-ATF compliance processes. In other words, they must be completely independent. Additionally, to assure independence, the business or compliance team cannot determine the scope of the audit or have authority to alter the contents of the report prior to its delivery to senior management and the governing body of the RFI. When conducting an audit of the AML-ATF program internally, it is necessary that persons tasked with the audit are sufficiently independent of the compliance function and that this has been verified. RFIs can also have an independent audit of its AML-ATF program conducted by an external third party. In such instances, the RFI must consider the independence of the individual signing the agreement with the third party, as well as the independence of the individual agreeing to the scope of the audit. In other words, any person involved in the day-to-day AML-ATF processes must not conduct the independent audit nor determine its scope. Moving on, the audit exercise must be completed on an annual basis at a minimum and should also include international sanctions compliance. Further details pertaining to the scope of the independent audit can be found in paragraph 1.83 of the guidance notes.
Does the independent audit require the establishment of a separate dedicated department?
The short answer to this question is no. In cases where an internal audit department exists, the independent audit function referenced in Regulation 17A does not require the establishment of a separate dedicated department. As already communicated, an internal audit department can perform the audit. In saying this, the department must be adequately resourced and the audit must be appropriately scoped and focus solely on AML-ATF matters such that the audit is separate and distinct from the RFI's general audit. In the instance that an organization does not have an internal audit department or is unable to demonstrate sufficient independence, perhaps due to its size or other resource factors, it is advisable that an external party is engaged to conduct the independent audit.
Can an independent audit review be conducted on a dynamic basis in line with the risks of the RFI?
As previously mentioned, the independent audit must be conducted at least once per year. However, it is important to note that it should be conducted more frequently when senior management becomes aware of gaps or weaknesses in the AML-ATF framework or as deemed necessary following an assessment of risk. For clarity, an RFI can conduct smaller thematic reviews of its AML-ATF framework throughout the year, provided that all topics are covered within 1 year to satisfy requirements. The topics that need to be covered for an independent audit can be found in paragraph 1.83 of the guidance notes.
Should the periodic report from the compliance officer include actions taken to address issues identified in the independent audit?
Certainly. Please note that the authority has amended paragraph 1.52 of the guidance notes. It now clarifies that the compliance officer's periodic report should contain the actions and outcomes of any relevant quality assurance activities, independent audit, or internal audit reviews.
We'll move on now to questions relating to the topic of ongoing monitoring. How frequently does ongoing monitoring need to occur?
Prior to diving into this question, it is necessary to provide some context. Ongoing monitoring is an important component of an AML-ATF program and requires the application of a risk-based approach to determine the frequency and scope. This means that RFIs should direct greater ongoing monitoring resources towards those products, services, and business relationships that present a higher risk of MLTF in comparison to aspects which present lower risk. With specific respect to the ongoing monitoring of the customer, RFIs must first perform a customer risk assessment for each of its business relationships. This assessment should allow the RFI to determine the initial risk rating for the customer based on information gathered from the customer's application form, their risk profile, and initial activity. Once a customer's MLTF risk score has been determined, such as being deemed high, medium, or low, the business relationship should be monitored on a frequency based relative to the assigned risk level. Although not prescribed in the guidance notes, common frequency review schedules for high, medium, and low risk rated business relationships are 1, 3, and 5 years, or 1, 2, and 3 years. Another important aspect of ongoing monitoring relates to transactions monitoring. The key features of this includes ensuring that any activity and transactions are consistent with the customer's risk profile and monitoring transactions to determine whether any large, complex, or unusual patterns of transactions have occurred. A third component of ongoing monitoring, to go along with the initial customer risk assessments and transactions monitoring, relates to the review of existing customer due diligence documents, data, and information to ensure that it remains accurate and up to date for all named parties. In addition to predetermined ongoing monitoring, trigger events can also occur that require an RFI to conduct further monitoring. A trigger event can arise from internal firm knowledge, external events, or be customer-driven. Examples of this include when a customer is internally identified as becoming a politically exposed person, when the RFI reads negative media about the customer, or when the customer notifies the RFI of a change in beneficial ownership. In all of these situations, the RFI is required to revisit the due diligence undertaken on the customer and understand whether the client's risk profile has changed. As a result, it may be necessary for the RFI to obtain further information and update the CDD on file. As a closing remark, with respect to this question, all aspects of ongoing monitoring must be appropriately documented on file.
The next set of questions relates to the business risk assessment process. What are the RFI's obligations to document and conduct a business risk assessment?
In broad terms, an RFI must document its risk assessment methodology and results, noting that the business risk assessment should reflect the nature, scale, and complexity of the business. Once established, the risk assessment methodology and corresponding results must be regularly reviewed and amended as necessary to ensure that they are kept up to date. With reference to the business risk assessment, it involves 6 steps as highlighted on the current slide. As listed, this cycle involves identifying and assessing inherent risk, establishing the risk tolerance and risk mitigation measures, evaluating residual risk, implementing risk mitigation measures, and monitoring and reviewing the risk. These specific details can also be found in paragraph 2.26 of the guidance notes, while paragraphs 2.15 through 2.86 of the guidance notes provide in-depth guidance on what should be included in a business risk assessment.
How should an RFI assign risk ratings?
Using the risk-based approach previously mentioned today, an RFI must be able to demonstrate that it follows appropriate and documented procedures for assigning risk ratings to each new product, service, or technology prior to launch. The same also applies for each business relationship it accepts or maintains, inclusive of any outsourcing and reliance relationships and each occasional transaction that is conducted. Sector-specific guidance issued by the BMA, Financial Action Task Force, or any other relevant organization may also prove useful to RFIs in assigning risk ratings and determining appropriate mitigation measures. Ultimately, the purpose of an RFI applying a risk-based approach is to ensure that its compliance resources are allocated to the risk areas where they are needed and where they have the greatest impact in preventing and suppressing financial crimes.
The next topic relates to documentary evidence and translating documents. How should an RFI determine an appropriate translator, or what or who is appropriate to be relied upon for translations? For example, would the authority consider Google Translate a reliable translation source?
In short, an RFI must be satisfied that any translation is a fair and true representation of the original document. Therefore, technology tools can be used as long as the RFI is satisfied that the results of the translation have met this standard. When it comes to CDD documents in a foreign language, all materials must be translated into English. Examples of this include IDs, proof of residential address, and corporate documents. In contrast, the translation of other documents, such as underwriting documents or financial statements, is outside of the scope of this AML-ATF guidance.
The next set of questions is about documentary evidence and documentary verification. Should an RFI continue to obtain a utility bill to verify an address where identity verification occurs by way of a government ID, which includes the principal address?
Essentially, all key customer identification attributes must be verified using appropriate source documents. Documents required for verification will of course depend on the information provided in any particular source document. The authority has updated the wording in paragraphs 4.26 and 4.27 of the guidance notes to add clarity on the documentary evidence required to verify identity. To be clear, RFIs must identify and verify all of the items shown on the slide in relation to the customer. This includes full legal names, former names, or any other names used, the principal residential address, date and place of birth, nationality, and a personal identification number in a government-issued document. It is also important to add that an RFI may accept either physical documents, electronic information and data, or a combination of both when verifying the items shown. When using documentary evidence to verify the identity of a natural person, RFIs are recommended to use either a valid government-issued document, such as a passport, national ID card, or driver's license that includes the natural person's full legal name, photograph, and one of either the principal residential address, date of birth, place of birth, or nationality. With specific reference to verifying a customer's address, the documents listed can also be used. This includes an instrument of a court appointment, current land tax demand letter, current bank or credit/debit card statements, or a utility bill. As mentioned, these details can be found in paragraphs 4.26 and 4.27 of the guidance notes.
The next subject for discussion is the electronic verification process and non-face-to-face identification and verification. Should non-face-to-face business transactions be considered high risk?
Before developing the answer further, it is necessary to note that business transactions include both financial transactions once a relationship is established and non-financial transactions to onboard a relationship or to update key details about an existing relationship. Given this, RFIs must take specific and adequate measures to assess the risk associated with non-face-to-face transactions and compensate for any higher risk based on knowledge of the customer and the accompanying profile. If it is determined that a higher risk is posed, an RFI must take additional measures as deemed necessary. This includes the use of a reliable and independent digital application or tool to assure that it is the owner of the account who is transacting. At all times, RFIs should be aware of the inherent risk of impersonation fraud associated with non-face-to-face identification and verification.
Can RFIs onboard customers in non-face-to-face interactions?
Yes, RFIs can onboard customers via a non-face-to-face interaction, but must consider the enhanced due diligence measures outlined in paragraphs 5.25 through 5.28 of the guidance notes. As a general comment, the authority is supportive of non-face-to-face onboarding, leveraging the technologies which are now available to validate and verify identity and related attributes in non-face-to-face scenarios. However, as per paragraph 5.27 of the guidance notes, when using a digital identification verification application or tool, RFIs must ensure it is reliable and independent. The tool must also adequately protect against internal and external manipulation or falsification to avoid creating false identities.
The next topic is outsourcing, and our first question is, who holds responsibility for the oversight of an RFI's outsourcing activities?
In short, an RFI's governing body is responsible for the oversight of any outsourced activities. Expanding further, the RFI's governing body is responsible for clearly documenting and defining the roles, responsibilities, and duties for all outsourced activities as if the activities were performed in-house. Therefore, in practical terms, an RFI's board is ultimately responsible for ensuring there is effective control and oversight of any AML/ATF outsourced activities. This does not mean that the board must perform these functions directly, but they are ultimately accountable.
If an RFI's compliance function is carried out by the parent company, A, is this considered outsourcing or insourcing? And B, is an outsourcing agreement required to be in place?
Let's begin by firstly addressing the terms outsourcing and insourcing. When an RFI uses a service provider to perform an activity, such as applying customer due diligence measures that would normally be carried out by the RFI, this is considered as outsourcing. Moving along, when another entity within an RFI's group undertakes AML/ATF activities or reviews processes, this is often referred to as insourcing. However, the activities are still considered as outsourced from a regulatory perspective. Having made the distinction, an outsourcing arrangement should be in place for all outsourced activities, whether the service provider is an external third party or within an RFI's group, and irrespective of whether the service provider is in Bermuda or overseas. An outsourcing agreement is important to remove any doubts about each entity's roles and responsibilities. Further details pertaining to the requirements of the outsourcing arrangement can be found in paragraph 5.164 of the guidance notes.
We'll move on to a final set of questions on the topic of NRAs and how this relates to RFIs. Thinking about the NRA, why should this matter to RFIs?
As mentioned before, RFIs are meant to take the results of the NRA, including the MLTF threats and risk identified, and incorporate them in their business risk assessment.
Practically speaking, what are employees, managers, and board members meant to do as a result?
Specifically, the NRA identifies sector-specific risk ratings and product and service vulnerabilities. If an RFI is in a high-risk sector with high-risk products, then using the risk-based approach, enhanced due diligence and monitoring should be applied to the most vulnerable products and services. For example, if a compliance officer works for a trust company, the NRA has determined that the trust business is high risk, and in particular, private trust companies and discretionary trusts have a higher MLTF rating, and therefore, more scrutiny and control should be placed around those trust products.
To sum up, we note that the National Risk Assessment is important to Bermuda's overall AML-ATF framework, but what significance does it have beyond that?
Bermuda is expected to have a CFEDF mutual evaluation in 2027. What this means is that senior management at RFIs will be interviewed to determine if they are aware and understand Bermuda's money laundering and terrorist financing risk, their sectoral money laundering and terrorist financing risk, and are compliant with Bermuda's AML-ATF regulations. The evidence of practical application of the AML-ATF regulation must be provided from 2021 onwards. To prepare, RFIs must read the guidance notes and the national risk assessments and be able to speak to Bermuda's MLTF risk and their sector's MLTF vulnerabilities and adjust their company's AML-ATF framework accordingly. Practically, to protect Bermuda's AML-ATF framework, RFIs need to be taken care when dealing with onboarding and transacting with international clients, as the majority of MLTF is connected to cross-border transactions dealing with foreign predicate crimes. This makes the CDD onboarding and gatekeeping and monitoring processes that financial institutions engage in even more critical in order to detect, protect, and prevent MLTF PF in our financial services sector. Thank you for your attention today. We hope that this presentation answered some of your questions about money laundering, terrorist financing, and our approach to combating financial crimes. The authority would encourage staff of regulated financial institutions to read the Anti-Money Laundering General Guidance Notes and the latest versions of the Money Laundering and Terrorist Financing National Risk Assessments, which you can find on our website at bma.bm. If you have any further questions as a result of this session, we encourage you to contact your industry association or reach out to us directly on aml@bma.bm.